All right, good afternoon, everybody. Today we're going to talk about taxation of Social Security and how your income sources can either cause you to pay more taxes or less depending on how you set up your income withdrawal plan. We'll be getting started in just a moment, and hang with me here through this little intro. All right, good afternoon, everybody. I hope you're all having a spectacular day. Here in Southern California, it's about 80 degrees. It's really nice. People are out swimming. I hope you all are enjoying some great weather wherever you're at. But if it's a little cooler than that, it's okay. Winter is coming, fall is coming. I'm seeing some amazing pictures from some of my clients that are up in the Northeast, Maine area, things like that. And I am jealous that even though it's nice here, it's nowhere near as beautiful as it is up in that northeastern area, or even some of the northwestern area up in Oregon or Washington. So appreciate what we have, appreciate the weather. And today what I really want to talk about is your biggest concern. So there was a question posted in the group earlier this week by me saying, hey, what do you want to learn about? What's important to you? Because hopefully, you know, in this group, my goal is to give you the best information so that you can retire with confidence and help you achieve your goal. So every week here, we're going to be doing a training on Sundays in general, right around 2 p.m. Pacific time, so that we can increase your retirement knowledge, and the training is going to be based on what you really want to learn about. So for those of you that are new to this group, maybe you don't know me, my name is Jason J. Hamilton, and I am a chartered retirement planning counselor, and I'm the CEO of Keep It Simple Financial Planning, which is a registered investment advisor here in Orange County, California. We do help clients from here all across the country. We have clients in about 8-9 states at this point. So if you have questions, if you need anything along the way, please feel free to reach out. We're definitely going to help you out with that. But today, what I want to talk about is taxation of Social Security, because it seems like that's a pretty big concern for everybody. So if you can hear me, I want to make sure I'm coming in clear. There's no delay. There's no sound noise. So if you can give me a thumbs up or just say hello, I can hear you, anything like that, I'd really appreciate it, because I would hate to jump into the training and then find out a couple minutes later, because there is a lag, obviously, with the internet and things going to satellites and coming back, that you missed out on some of this training. So if I can get a few thumbs up or just saying yes, you know, put a comment in that you can hear me, I would appreciate that. I'm going to give you just a minute to do that before I jump in. Okay, great. I'm seeing some comments. Okay, wonderful. Perfect. So welcome everybody to today's training. This subject is something that's actually really important, because it's going to continue if you are in the process of claiming Social Security, or if you're already claiming Social Security. Some of the things we're going to talk about today are going to be extremely impactful for you, for the amount of money that you actually take home. Okay, so that's, at the end of the day, that's one of the things that's most important to me, is that you take home the most money after the government gets their little hands in your retirement savings pot. So I don't want you to pay one more dollar than is necessary on any of your retirement income sources. So with retirement withdrawals, withdrawing from retirement sources is so much different than contributing. So most of you probably contribute to a 401k, an IRA, a 403b if you're in the public service space, one sort of retirement plan. So really all you had to do was put some money in there. Maybe you put money into, you know, one of the, just a set of different mutual funds, some index funds, or even just a target date retirement fund. All you had to do was select the percentage that you wanted to put in your account and move the money over, or the dollar amount. That's pretty easy. But when it comes to tax efficient withdrawal strategies, this is where it can get a little bit tricky, because if you get it wrong, you can end up paying a whole lot more taxes than are necessary. So what we're going to talk about today is the impact of income and withdrawals on your Social Security taxes. Okay, so let's jump into some of this training today. I'm going to add myself like I do in the bottom left corner here so that you can see my face. And as a reminder, along the way, if you have any questions, go ahead and just drop them in the chat, and I will periodically check in during the training and also after to do my best to answer your questions, so that you feel that you have a really good understanding of what we're talking about today, because that is my overall goal. So as I mentioned, the title of today's training is Taxation of Social Security Benefits. And I'm going to give you planning strategies to mitigate the impact of taxation of your Social Security benefits, okay? Because there are some things you can do so that you keep more of that money, and I'm going to talk to you about that. But I want you to understand what you're dealing with, what the impact is, and what are the things you should be looking for as far as planning for taxation of Social Security. So let's get into this a little bit here. Okay, so here's the term you need to know. Provisional income, okay? So Social Security benefits are subject to taxation only if the workers or your total provisional income exceeds certain thresholds, okay? So what we're not talking about here is, I think we've talked about this over and over and over in the group, but if you're working and you are not full retirement age yet, and as of this year, if you earn over $17,040, you're going to lose $1 for every $2 you earn above that. That's not what we're talking about here, okay? What we're talking about is if you have any income sources, because with the Social Security benefits, losing income, you don't lose income by taking withdrawals from your IRA. You don't lose any income from taking withdrawals from your 401k or pensions. The only time you lose income with if you take Social Security before full retirement age and you're still working and you earn over $17,040 is if it is earned income, okay? So that is self-employment income, that's income from a job, anything like that. That's the only time you have an effect. But when it comes to withdrawing from your accounts and taking distributions, not from Roth IRAs, but from things like IRAs, 401ks, 403bs, you have to be considerate of the taxation on your Social Security. So up to 85% of your Social Security can be taxed. So calculating provisional income, and once you get past those certain thresholds, is how you're going to know if you're going to owe taxes on your Social Security. So I think this is a really, really important training for this time of the year. This is a great time to start doing some tax planning when it comes to what you're going to take from your tax deferred accounts, if you do have any, okay? So let's, oh, yes, I did put in here. If you want to get really detailed and you want to get nerdy on this for a detailed explanation of provisional income, you can go to the IRS website and search for publication 915. That'll give you all the details, and it'll give it, I'm going to give it to you in a simple, straightforward format. And if you go there, you're going to get a lot more detail, but we're going to cover really the same thing at the end of the day. So my goal is to keep things simple, hence the name of my firm, Keep It Simple Financial Planning. So how is provisional income calculated? Okay, so it is calculated as follows. And at the end of this training, I will give you a worksheet. I was going to create my own, but AARP had a great one. It walks you through all the steps. I'm just going to use theirs, and I'll drop the link down in the training after so you can calculate yours using a worksheet. But the formula is you take your adjusted gross income. So this does exclude Social Security at this point. So AGI, so this does include distributions you've taken from a 401k, 403b, IRA. That was one of the big questions, okay, that inspired this training. So it does include income from there, okay? You take your adjusted gross income, and then you add any sort of non-taxable interest. So muni bond interest. Muni bonds are great for taxable accounts because in general, you're not going to pay any taxes on those, and especially if they're state specific. But in this case, you have to add the non-taxable interest from your muni bond interest, okay? So adjustable AGI, adjustable gross income, plus non-taxable interest, plus 50% of your Social Security benefit. You add those three together, and that gives you your provisional income, okay? So any questions on that? I'm going to take a minute and pause and give you a second to drop any questions down in the comments, and I'm going to take a look while we do that. Okay. So yeah, Pam asked, what about pension income? Yeah, pension income is calculated in this. Pension income is included in your AGI, right? So anything that is a part of your adjusted gross income is going to be included in this calculation. So very important. That's a great question though. So I don't see any questions coming in. I'm going to give it a minute, but I will keep an eye. Okay, so depending on your provisional income, you could pay tax on up to 50% or even 85% of your Social Security benefit. Okay, so up to 85% of your Social Security benefit can be taxed based on your provisional income. So when it comes to tax efficient withdrawal strategies, something I really take a look at is how is this going to affect your provisional income based on what we withdraw, when we withdraw it, and our overall withdrawal plan. Okay, so what you need to know is benefits are tax-free. Okay, so this means your Social Security benefit. Your Social Security benefit is tax-free if your provisional income is less than $25,000 if you're filing as single or head of household, and I'm talking about filing your taxes, or $32,000 for those of you that file a joint return, so married filing jointly. So if your provisional income is less than $25,000 single or less than $32,000 if you file a joint return, then your Social Security benefit will be tax-free. Okay, so if you're going to be above that, that's when you have to start looking at provisional income and how it's going to impact what you take home after taxes. Okay, if your provisional income is between $25,000 and $34,000 on a single person's return, so if you're filing as a single on your tax return, or $32,000 to $44,000 on a joint return, for every dollar of income between the lower and upper basis, 50 cents of Social Security benefits become taxable, up to 50% of the total benefit. Okay, so if you're in that range, when you do the calculation based on the formula I just gave you, if you're 25 to 34 single and 32 to 44,000 on a joint return, for every dollar of income between the lower and upper basis, 50 cents of Social Security benefits become taxable, up to 50% of the total benefit. Okay. Again, if you have questions, drop them in the comments. I will pause along the way and do my best to jump in and answer those. Okay. So here's what it looks like in a chart form. Okay. So if you're below 25,000 and you're single, or married and filing living separately, okay, below 25,000 provisional income, you're okay. Once you hit 25,000, every dollar above that is taxed at 50%. And that goes up until 34,000. Once you hit 34,000, then 85% of your Social Security benefit is taxable to you. If you're married filing jointly and you're below 32,000, then you're in the clear. Once you hit 32,000, now you're going to be paying tax on 50% of your retirement of your Social Security benefit for every dollar you have above that, up to $44,000. And once you hit $44,000 and above, then 85% of your Social Security benefit will be taxable. So for those of you that have large pensions, this is definitely something you need to be considering when it comes to your Social Security income and how it's going to be taxed. So a lot of folks in here, for example, if you're a teacher, and teachers, I think it's 20 or 25 years, you guys can correct me. Once you have that, you qualify for pension, or if you're in the public service, if you're a fireman, if you're a police officer, things like that. So you can get a pension really early on and take it, early on in your years. And so most folks that are on pensions want to take their Social Security as early as possible. I see that all the time. Well, keep in mind that if that's the case, there's a good chance you're going to be paying taxes on that Social Security. So the benefit you see is going to be taxed, so your net benefit will be lower than what it shows on your Social Security benefit statement. Okay, I'm going to check in for questions really quick while I'm doing this. If you have any questions, again, drop them. I'm not seeing anything coming through yet, but sometimes things can be a little slow. Okay. Let's see. Okay, so no questions yet. I'm going to go to the next screen. Okay, so if your provisional income exceeds $34,000 for singles or $44,000 for married couples, then for every dollar of income above that threshold, and this is your AGI, 85%, this is your provisional income, 85 cents of your Social Security benefits become taxable, up to a total taxable amount of 85% of benefits. I know that's a little bit confusing. Let me repeat that. If you're above these thresholds, $34,000 for single and $44,000 for married couples, then for every dollar of income above these thresholds, 85 cents of Social Security benefits become taxable, up to a total taxable amount of 85% of your benefits. So what that means is, regardless of your provisional income, 15% of your benefit will always be tax-free. So this is currently, right now it's always, that's what's in the law. They're looking for a lot of solutions to fix the Social Security system and then other ways of taxation. Keep this in mind when you are voting, that if this comes up, this may be another way to tax you additionally on your Social Security. But right now, 15% of your benefit will be tax-free, okay? Okay, here's the sad part. These thresholds are not indexed for inflation. So what that means is each year, more of your Social Security benefits are going to be taxed because you're going to get cost of living adjustments. So yay, we're getting 2.8% this next year as a cost of living adjustment. But if you're already being taxed on your Social Security because you have provisional income that exceeds the limits, well, then a little bit more of your Social Security benefit is going to be taxed each year due to cost of living adjustments. So this is something that if it's just pension income and that's all you have, it's pretty tough. But if you're drawing from a IRA or 401k, which is one of the main questions we had on why we did this training, there's some strategies you can do to avoid this on every other year, every couple years, and I'll talk about that shortly. Okay. So, as you probably know, most states don't tax Social Security benefits, but there are 13 that do at varying levels. So, if you're in any one of these states, be considerate of that you may owe state tax on your Social Security as well. That's just beyond the scope of this training today, so we're not going to get into that, but keep this in mind if you live in any one of these states. Okay, so I'm going to give you an example here of what these calculations will look like and just kind of walk you through step by step on a couple scenarios. Okay, so we're going to talk about Bob and Rita at this point. So Bob and Rita have an adjusted gross income of $28,000. Okay, they also have municipal bond interest of $1,000, and their Social Security benefit together is $22,000 per year. So on average, pretty low benefit, but this is what this scenario is. Okay, so so we'll take their AGI of $28,000. Okay, following the formula, you're going to take the AGI, the adjusted gross income of $28,000. You're going to add the municipal bond interest of $1,000 in this case, plus $11,000, which is 50% of their Social Security benefit. Okay, so let's go back, and I want to show you here. $28,000 was their AGI. They had a municipal bond interest of $1,000, and their Social Security benefit is $22,000 a year, so we take 50% of that amount. Okay, and I believe on your Social Security statement, it's going to be box 5 on your statement where you'll find your Social Security benefit for the year. So you're going to add $28,000 plus $1,000 plus $11,000, which is 50% of the benefit, and that gives you $40,000. And they are going to file married filing jointly. Okay, so in this case, since they're married filing jointly, the threshold is $32,000. They are $8,000 above the low end of the threshold range. So you take $40,000, you subtract the low end of the threshold, and that leaves you with $8,000. That's in the threshold range where they will be taxed on part of their Social Security income. Okay, so you get those numbers. So since up to 50% of benefits are taxable between $32,000 and $44,000 for folks that are married filing jointly, then you take 50% of the amount that they're above that, which is $4,000. So what that means is $4,000 of their benefit amount will be taxable. Okay, so I know this may be a little bit confusing, but if you follow the steps, and I'm going to give you a worksheet to follow the steps, it really is pretty straightforward. So let me go back a screen just so we walk through that one more time. So we're going to take their AGI, which is $28,000 plus $1,000 of municipal bond interest, plus $11,000, which is 50% of their Social Security benefit. You add those up, and that gives you $40,000. Okay, so that's their provisional income. Since their provisional income is $8,000 above the $32,000 low end of the range, we have to use that $8,000 number as the amount they could potentially be taxed on of their Social Security income. The good news is it's only 50% of the benefits that are taxed of the amount above 32. Above 32 and lower than 44. So 50% of that amount is $4,000. So $4,000 of their benefit amount will be taxable. So again, this is not the end of the world, but this is a pretty, I would say average to low income when it comes for AGI from retirement. Some folks are a lot higher. Some of you may be lower, but having $4,000 of your benefit amount be taxed, if you're in a 25% tax bracket, it could be $1,000 in tax. So it's $1,000 less money that you're taking home that you have to use for your needs, expenses, vacations, things like that. So it can definitely impact your standard of living. Okay, before I jump into Peter and Faye, I want to take a minute and see if there's any questions on this. And I will give you a minute with that here and check on our comments. Okay, so Gail asks, is this only if I'm not full retirement age? Yes, that's correct, Gail. If you're full retirement age, it goes up to about $44,000 and change. And then if you're past 70, then it's not taxed anymore. So that's a good question. Dorothy asks, what is all considered provisional income? So any sort of income that would fall under your adjusted gross income. So AGI. So if you have pensions, if you have distributions from 401ks, traditional IRAs, Roth IRAs are not counted towards AGI. So that's really important. That's why it's great to have some diversified tax sources when it comes to planning for retirement, because you can potentially take a distribution from a Roth in a certain year when you would normally pay provisional income and lower the distribution from your traditional IRA or your 401k. So good question. What happens when a spouse works? Mary Lou asks. So if a spouse works and you're married filing jointly, then that's all going to be considered income, right? That's all considered income that falls under AGI. So that's going to have an effect on your provisional income. So if you're taking Social Security and you have income sources, again, this is all going to be counted as how your Social Security is going to be taxed. And that's why I think there were so many people interested in this subject, because it's a little bit confusing. But once you understand the step-by-step calculations, it makes sense. But there are ways to manipulate to keep your income low, which I'm going to talk about here when we get to the end of the training. So if there's no further questions, I'm going to jump into here with Peter and Faye, okay? So Peter and Faye have an AGI of $60,000, okay? So their adjusted gross income from all their sources is $60,000. In this case, they have no municipal bond interest, okay? And they also have Social Security benefit, which is $42,000 per year. So what is that going to look like? So we're going to take their $60,000, which is your AGI. We're going to take 1/2 of the Social Security benefit, which is $21,000. So if you add those two together, that gives you $81,000 of provisional income. Okay, so in the $32,000 to $44,000 range of their provisional income, 50% of their benefit is taxable. So since the range is $12,000, they're going to pay tax on 50% of that. So they're going to pay tax on 50%, which is $6,000. So $6,000 in that range becomes taxable of their benefit. And then since they are $37,000 above the $44,000, which is the top of the 50% threshold. So in this case, I'm taking $81,000 minus $44,000, and that gives you the $37,000. Okay, that's where the $37,000 is coming from. They now have $37,000, which is going to be an 85%, which is an 85% tax threshold. And this is where it gets a little confusing. So that they're going to pay 85%, they're going to pay tax on 85% of that amount, which is $31,450. So the amount above the $44,000 threshold, which is $37,000, they're going to take 85% of that amount. So you do 0.85 times 37,000, and that gives you $31,450. That amount is going to be taxable since that's above the threshold there. Okay, so we're going to take the $6,000 from the initial threshold from 32 to 44 and add that to the $31,450, and that gives them a $37,450 potential taxable amount, okay? But here's a step you need to include. We must make sure that this amount is no more than 85% of the total benefit amount, because remember, 15% of your Social Security is always going to be tax-free. Okay, so we're going to compare these two in the next slide. Okay, so their total benefit for Social Security, if you remember, is $42,000. So we're going to multiply that by 0.85, so that gives us $35,700. So this is the maximum amount that can be taxable, and it is lower than the $37,450 that we arrived at. So only $35,700 is a taxable amount for Peter and Faye. Okay. So I hope that makes sense. I'm going to take a minute and pause. If you have any questions, I can go back a screen. But let's see if you do. I know this is a little bit confusing, but this is really, really important for you to know. Okay. And this is what you're asking about. Okay. So don't see any questions on this, so I'm going to go to the next screen. So hopefully that all made sense. As an interesting point, about 70% of Social Security recipients pay no tax. So 7 out of 10 people aren't going to pay any tax on their Social Security. Only about 15% are taxed on 85% benefit because they have high incomes. So this is a pretty small sector, but I'm pretty sure most of you are in this range, which is why there was so much interest in this. The final 15% are in this middle income range, okay? And this is where, when you're in that middle income range, the tax on the benefits starts to phase in. Recipients in this phase-in range are subject to what is known as the tax torpedo, okay? It's just, I didn't make up the term, it's just what it's known as, but there's probably a lot of folks in this range. And what the studies say is generally those with wealth between $250,000 to $600,000 are most susceptible to this tax torpedo. That's the general case for most folks that are in this range. So this is a lot of folks that have done a good job of saving and they've crossed that range. If you're below that, when you're taking withdrawals, there's a good chance you won't pay any taxes, but you got to keep, if this is you, if you're in this range, then you're definitely most susceptible to this tax torpedo. Okay. Now I want you to consider. Now I want you to consider a situation where an individual takes an IRA or 401k distribution of $100. Okay. You will pay tax on the full $100 because that's taxable, right? Taxable income if it's a traditional IRA or a traditional 401k, not Roth. Okay. And because this distribution is part of your provisional income, it could trigger or bump up the amount of tax you pay on your Social Security benefit. So to mitigate this tax torpedo, one could take advantage of a planning strategy referred to as the reverse tax torpedo. So hopefully, I should have told you at the beginning, please take a pen and paper out so you can take some notes here, but this training will be in here for you to review later. But there's a strategy called the reverse tax torpedo. So how that works is, what you'll do is you'll delay claiming your Social Security benefit until all other taxable income has been exhausted, okay? So if you can delay, not taking Social Security at 62 to, at least full retirement age, if not later, and drawing on your taxable income instead, that will help you avoid the tax torpedo. And then when Social Security does begin, your total provisional income ideally will then be below the threshold for taxation. And then the benefits can be received tax-free. So we talk about this in this group a lot. There's a lot of benefits to delaying Social Security and having a tax-efficient withdrawal strategy. And then going along with that, there's Roth conversions that you can do before you take Social Security and move money from a tax-deferred account into a tax-free account. These are all things that can be added in there. I'm going to talk more about that in just a minute. So if that blew over your head, don't worry about it too much. But when Social Security does begin, you're going to lower your provisional income. This is the same thing like when your RMDs began, your required minimum distributions at 70.5. If you were to delay Social Security and either live off some tax-deferred income or take some of that tax-deferred income and convert it to tax-free income through Roth conversions, this is another way. So long-term, you'll pay less tax on your Social Security benefit. So if you take Social Security early and you don't draw down on your tax-deferred accounts, this is opening you up to paying a lot more tax on your Social Security benefit later. So in reality, your take-home income, or what you actually get to keep after taxes, gets reduced by taking Social Security early. So a lot of benefits to delaying Social Security. I do understand there are other situations where you can't because you need the income or you have health concerns. But in general, if you're healthy and you don't need the income because you can live off your other accounts, this is a great way to reduce your provisional income later and pay less tax on your Social Security. Okay, so now I want to talk about some planning strategies to mitigate the impact of taxation on Social Security benefits. So these are the strategies that I use with clients to help them mitigate this impact if they're in the process of deciding whether they should take it, how do we keep their taxes low, and what accounts to withdraw from when, and how to avoid paying one more dollar of taxes than necessary from your savings and investments. Okay, so one strategy you can do, and I'm giving you guys a secret sauce here, okay? You can do this stuff on your own if you want. I don't recommend it. I recommend you work with a professional, whether it's me or another fiduciary financial planner. You know, I recommend fee only, of course. But doing this on your own can get a little tricky. Maybe your CPA can help you out with this as well. But what you can do is you can stagger withdrawals from tax-deferred accounts so that you exceed the tax threshold on Social Security benefits, say once every 2 years, for example. So what does that look like? What that looks like is maybe you draw this year, right, from your tax-deferred account, and then you put that money either just in a savings account or some sort of interest-bearing checking account, whatever it may be, and you take 2 years of income out this year for what you'll need, and then next year you don't draw from your tax-deferred account and you live off the money you pulled the year before, and so then in the second year you won't pay any taxes on your Social Security income. So that's a great way to do that, but that takes some strategic planning, and you really want to make sure you're doing this correctly so that you don't essentially pay extra taxes in 1 year and then pay tax again the next year because you didn't do it right. That would not be good, okay? Another strategy is you can time the sale of stocks and any other appreciated property for years when you're already subject to tax on Social Security payments, or for when you're below the threshold. So if you already know you're going to be subject to taxes on your Social Security payments, and you're thinking about selling some stocks or other appreciated property, then maybe you just take the hit this year or whatever year that's going to be, so that the following year or for another year, when you know you are going to be below the threshold, that you can avoid these taxes. So I think this is a smart strategy. Another thing you can do is time your tax-free withdrawals from your Roth IRAs so that these distributions do not contribute to provisional income. Because when you take money from a Roth, that doesn't get added to your AGI, right? So if you're above 59.5 and you're taking your earnings out, you don't have to pay any tax on earnings on Roth IRAs. So you can time your distributions to take from a Roth 1 year to cover your income needs. And then that way you get to not be taxed on your Social Security. So at the end of the day, you're netting more take-home money. And again, maybe you put that money aside or potentially need to live on, but we're going to keep your taxes lower by doing that. Okay, so this Roth conversions are a really, really powerful strategy, okay? I do not recommend that you do them on your own. I recommend you partner with an advisor or a CPA or somebody that can help you do this the right way, okay? But if you're going to convert some money from a traditional IRA to a Roth IRA, that will increase your income for the year, okay? So ideally, I actually prefer that you would do these before you even start your Social Security payments. So if you have a large tax-deferred account, like let's say all your money is in a 401k or an IRA, or a traditional IRA, I should say, and you don't have a lot of money in a Roth IRA or just a typical taxable brokerage account or just your bank account, and all your income is going to have to come from tax-deferred money, well, before you take your Social Security benefit is a really, really good time to convert some money from traditional to Roth, okay? This calculation needs to be considered not only for Social Security and provisional income, but also your long-term tax-adjusted wealth, okay? Because for some people, it actually is going to make more sense that they keep all their money tax-deferred, even if they pay a little bit of Social Security or a little bit of tax on their Social Security. It'll make more sense for them depending on their situation. So you really want to look at holistically when you're doing these type of strategies, not just like on an island, okay? This is not me telling you to go do this because this makes sense. You need to look at all the different areas and what tax brackets and what years it's going to make sense for you to convert some money from traditional to IRA, or excuse me, from traditional to Roth. Doing the conversion is pretty simple in a technical sense. You could just say, hey, I want to do this dollar amount I want to take it from traditional and move it to a Roth account. Then at the end of the year, you're going to get a tax bill and you want to have money available to pay those taxes. That's the ideal strategy. But you want to also max out lowest tax brackets if possible. If you're in a 25% tax bracket and you want to do the strategy, but then next year you're going to be in a 12% tax bracket, doesn't make a whole lot of sense to do it now. It's probably better that you wait. Same thing if you're going to be taking a year off, because mini retirements are very popular. I've talked to a lot of folks that are just going to take a year or two off, get in an RV, travel for a year, but then they're going to come back and work part-time or full-time after that, and that's the so-called mini retirement. That's another great time to do a Roth conversion, because you're going to have either little or no income coming in for that year, and you can max out something like a 12% tax bracket and pay no more than 12% on that money, and then have that money sit there now for a tax-free bucket down the road, so that when you get to Social Security, you can then pull from that bucket and keep your provisional income low. So I know I'm getting a little bit technical here. I hope I'm not losing you guys, but I'm trying to give you as much value as I can, and give you some things to think about when it comes to really maximizing your take-home incomes. I think that's really important. Okay, and then another thing you can do is eliminate the interest and dividends that are included in the provisional income formula. So if you don't need income currently, a tax-deferred, you can consider tax-deferred income by purchasing an annuity, right? So it needs to be I'm always cautious when I recommend these things, because I think annuities do have a purpose, but if you're potentially going to have a very high income later, you may consider doing a tax by purchasing an annuity to get that more tax-deferred income. Sorry, I'm stumbling over my words right now, but this could be really important. But again, whatever you do, don't just go put all your money in an annuity. That's almost never the right situation for anybody. But as a part of your planning strategy or income strategy, this might make sense for you if you have a high amount of tax-deferred income that's going to be triggering some provisional income and tax on your Social Security. Okay, let me move this screen because you probably can't see this here. And I'm sure some of you want to hear this. Another thing you could do is consider working less, right? So if you are in a case where you're working part-time, for example, in retirement, you've already taken your Social Security, even if you are not going to cross the $17,040 threshold to where you would lose $1 for every $2 you earn above that, you might still, by taking withdrawals from your 401k or IRA, you might cross into provisional income thresholds and cause taxation on your Social Security. So you may want to consider working less. That might be the right strategy for you. And so it may be a great time to take an extra vacation for the year. So these are all things that can be beneficial based on your individual situation. And I do recommend you get advice on your individual situation, that none of this should be taken as tax, financial advice, or legal advice for anybody in particular, okay? Okay, and another thing you could do is delay taking Social Security and instead draw down on other retirement funds, which will ultimately reduce your required minimum distributions after age 70, which will be part of provisional income. So we talk about this a lot in this group. I think this is a really good strategy, because not only do you increase your Social Security benefit, which lowers your longevity risk, and longevity risk is the chance of the probability of running out of money. We want to lower that to near zero if we can. So increasing Social Security does that by delaying. You'll also reduce your RMDs, which are going to happen after age 70 and a half, and then reduce the chances that will hit up on the thresholds of provisional income. And on top of that, you can also minimize expenses. So in this case, it might make sense for you to pay off your mortgage before retirement. One, you'll be in a better position to live off an income below the threshold, which if you don't have a mortgage payment or a housing payment of any sort, all you have to pay for is food, utilities, basic expenses. I think a lot of people can stay below this threshold when it comes to their provisional income. So that's a benefit of paying off your mortgage early. I know another question on the thread that I posted yesterday on what you want to learn about was, what are some of the benefits of paying off your mortgage early or carrying a mortgage into retirement? I've actually seen both scenarios make sense depending on the person's financial situation. But in this case, if provisional income and lowering your taxes there is the goal, then it might make sense to pay off your mortgage early, okay? So that's what I have for you today. I want to thank you for attending today's training. I hope you found value in doing this training with me and attending today and then letting me take up about 45 minutes of your time. But I know I covered a lot, okay? So if you would like additional assistance with your retirement planning, helping you reduce taxes, maximizing your Social Security, helping you create a strategy for tax-efficient withdrawals from your retirement accounts, that's what I do, okay? I want to help you out with that. I offer a complimentary retirement strategy call. It's with me personally. It's no salespeople. It's no one on my team at this point. I may have to hire sometime soon, but right now you're going to get a chance with me. We'll do either a phone call or we'll do a video chat just like this, and I will help you create a step-by-step game plan to help you reduce your taxes and really retire with confidence. So this is what it's going to look like on our call if you decide to take the next step. I'm going to give you overall a high-level game plan. I'm going to tell you what you're doing well, what you can do better, so areas for improvement, and then I'm going to dig in to help you figure out, are there any retirement planning items that you're just missing, okay? And you're going to walk away with a high-level step-by-step game plan that's unique to you on what the major financial items that you need to address before or in retirement are. So ask anybody that's been on a call with me. This is exactly what we do on every call. You're going to walk away with a lot of value, regardless if we end up working together. But if it makes sense, then I may invite you into working with me because you may need the help of a professional. If you don't, and I've definitely, about 1 in 4 people, I tell them, you know what, it's probably not the right time, or just go do this, this, and this, and I send them away to kind of, go do the things they need to do, and maybe come back later because it's not right? So about 25% of people that do reach out are not right, but I think that's the right way to do business. I'm not here to sell you anything. I'm here to serve and try to help you because I really, really do want to help you retire with confidence, and I know for some people, getting professional help is what they need, and if that's the case, then I'll definitely let you know what that would look like, okay? So if that's something of interest to you, I have very limited spots. I really do. I am going out of town the first 2 weeks of November. So what we're doing now is if people are right, excuse me, then we're going to be scheduling your onboarding probably for the end of November, early December, so that we have a chance to review tax implications and do some tax planning before the end of the year. So these spots are very limited. But if you're ready to take the next step and you want to get some help, some things I talked to you about today are really sticking with you and you're like, hey, you know what? I could use a game plan. Then what I want you to do is go to my website here at kisplanning.com/apply. KIS, like keep it simple, kisplanning.com/apply. And when you go there, all it's going to be is my scheduling page. So you're going to get a direct connection to my calendar. So you can schedule a time that works best for you based on your availability. And then you'll get asked a few questions that'll really help us prepare for the call so that we can jump right in and talk about what's most important to you and what are the things that you really need help with and need advice around and some guidance on. Because starting with the basic info, I'd rather not waste 15 or 20 minutes getting that. So there will be a little form for you to fill out. Some people see that and they get nervous, but I'm telling you straight up right here, it's just name, your retirement situation, and what you need most help with. Just a few questions so that we have the most beneficial time on our call. Couple things I'm going to put down in the comments here on this are going to be a link to schedule a time with me if you like. And then I'm also going to put the link to the AARP worksheet I thought was really good that will help you calculate provisional income to see if you may be affected by this. And if it looks like you're going to be affected by this, then I would definitely recommend you reach out, schedule a call, and see if there's some strategies we can put together so that you can keep more of your hard-earned money and your well-deserved Social Security that you paid into for 20, 30, 40 years. I want you to keep as much of that money as possible and not give it away to the government if we can do that, okay? So that's what I'm here for. I'm going to check in one more time to see if there's any questions before we wrap up for today. Let's see here. Let me go to... So I'm not seeing any more questions, but if you guys have questions and you're watching this at a later time, go ahead and drop them down below. I would love to chat with you. I'd love to get to know you a little bit better and love to see if I can help you out with your retirement planning situation. Once again, my name is Jason Hamilton, and I'm a Chartered Retirement Planning Counselor, and I am here to help you as you need. So thank you so much for attending today, guys. I appreciate it. Appreciate your time, and I look forward to meeting you. Drop your questions in the group. This last week, I've been in there as much as I could to answer as many questions as I can, but there are some situations that we do really have to dig into your personal situation that are not appropriate for a forum, okay? But please keep asking questions. I'll keep giving you answers. I really want to help you retire with confidence, and Other than that, have a great weekend. We'll talk to you guys soon. All right. Bye-bye. Thanks again for attending. I really appreciate you guys. Have a good one. Bye-bye.